Welcome back, traders. You're watching Prop Firm Ask, the channel that pulls back the curtain on professional Forex trading so you can level up your skills, pass prop firm challenges, and trade with confidence. Today, I'm giving you something special, a full professional playbook on how to trade Forex like a pro that we're going way beyond the basics. I'm talking about reading market structure with precision, understanding smart money concepts like order blocks, liquidity sweeps, and fair value gaps, applying the right technical confluences, managing your trades like a funded trader protecting $1 million account. This is a packed session for beginner to experts, so grab your notebook because you're going to want to take notes. And stay until the end. I'll break down a real trade that banked over 5R. And before we finish, I'll share how you can get exclusive prop firm coupons through Coupon Era to help you save money on your trading journey. Let's start with mindset, because trading like a pro means seeing the market through a very different lens. First, understand this. The Forex market isn't one big room where everyone trades together. It's decentralized. That means there's no single exchange like the stock market. Instead, we have a global network, the interbank market, where big players like commercial banks, central banks, hedge funds, and liquidity providers trade directly with each other. These big players are the ones moving the market. Retail traders, you and I, are just a fraction of the daily volume. That's why pros always think, where's the smart money going next? Now, currency pairs. Professionals mainly trade major pairs like EURIST, PUST, USD-JPY, and USD-CHF, plus commodities like gold, ZOST. Why? Because these have high liquidity. You get tight spreads, fast execution, and less slippage. Liquidity is like oxygen for a trader. Without it, you suffocate in bad fills and unexpected losses. Pros also analyze correlations. When DXY, the US dollar index, goes up, euro to US dollar often goes down. Australian dollar to US dollar often follows gold prices. US dollar to Japanese yen can be influenced by US bond yields. Another key, pros know the trading sessions. Asian session, low volatility, range-bound conditions. Great for identifying potential accumulation or distribution zones. London session, the power hour. This is where big moves begin. New York session, either a continuation of London's move or a brutal reversal, often around the New York-London overlap. Timing is everything. Trading a breakout at 3 a.m. London time is very different from trading it during the New York Open. Pros align with when the liquidity is in the market, not just where the setup looks nice. Market structure is the backbone of every professional strategy. Without it, you're trading blind. There are three main states of the market. Bullish, where price forms higher highs and higher lows. Bearish, where we see lower highs and lower lows. Consolidation, sideways movement, often a sign of accumulation before expansion. Pros track break of structure, BOS, and change of character, CHO, to spot when momentum shifts. For example, if we've been in an uptrend, making higher highs, and price suddenly takes out the last higher low, that's a major signal momentum might be shifting bearish. Another high-level framework is Wyckoff theory. Accumulation, smart money building long positions in a range. Markup, price trends up strongly. Distribution, smart money unloading positions. Markdown, price trends down. And then we have the liquidity game. Pros know exactly where retail traders are placing stops. For example, above a recent swing high, you'll find buy stops. Below a recent swing low, you'll find sell stops. Institutions will push price into these liquidity pools, triggering stop orders and filling their own positions at better prices. This is called a liquidity sweep or stop hunt, And if you don't know how to recognize it, you'll keep getting caught in it. Let's go deeper into smart money concepts, because this is what separates amateurs from professionals. Order blocks, OB. These are zones where institutions previously placed large orders. A bullish OB is the last down candle before an aggressive move up that breaks structure. A bearish OB is the last up candle before a sharp drop. These are high probability reversal areas. Fair value gaps, FVG. These occur when price moves so fast in one direction that it leaves an imbalance, a gap between the wicks of two candles with the middle candle running clean. Price often retraces to fill part of this gap before continuing. Breaker blocks. These form when an old order block fails, price breaks through it, and later retests it from the other side. Mitigation blocks. When price returns to an order block to mitigate orders before resuming in the same direction. And then the optimal trade entry, OE, popularized by ICT. This is when, after a market structure shift, you measure from swing high to swing low, or vice versa, and look for entries between the 62% and 79% Fibonacci retracement zone. This is where institutions often enter, because it offers a balance of low risk and high reward. Here's the truth. Professionals don't rely on 1,000 indicators. They keep a lean toolkit, EMA 20 and EMA 50, to confirm trend direction and momentum shifts. ATR, average true range, to measure volatility so stops aren't too tight or too wide. RSI divergence, spotting when price makes new highs or lows, but momentum doesn't agree. Fibonacci retracements, not as a standalone tool, but as a confluence with OBs, FVGs, and structure. Volume profile, showing high volume zones, HVNs, and low volume zones, LVNs, revealing where price is likely to stall or move quickly. Every pro trader has a plan, and they stick to it. It starts with top-down analysis, weekly chart for macro bias, daily chart for structure, for H chart for zones, 1H and 15M for execution. Then, clear entry criteria. For example, structure break, liquidity sweep, entry in OB plus FVG confluence, aligned with HDF bias. Risk is predefined, 1% to 2% per trade. And every trade is journaled, screenshots, reasoning, outcome. This is how pros refine their edge over time. Without risk management, you're just gambling. Position sizing is calculated. Risk to reward is planned before the trade is entered. Losses are accepted as part of the game. Pros don't revenge trade, they don't overtrade, and they don't deviate from their plan because of emotion. They use tools like trailing stops to secure profits, and they focus on process over outcome, because long-term consistency is what wins in Forex. Here's a real-world example. Daily chart. Pound sterling to US dollar showing bearish structure after a strong break of a higher low. 4H chart. Bearish order block aligns with fair value gap at 1.2750, right in the OE Fibonacci zone. 15M chart. Price sweeps liquidity above a short-term high, retraces into OB plus FVG confluence, prints a bearish engulfing candle. Entry short. Stop above the OB. Target next liquidity pool. Trade runs for 5 times our risk in under 8 hours. This is the type of precision trading you want to aim for. About luck. It's about skill, discipline, and execution. And if you're trading with a prop firm or planning to. Don't forget to check out Coupon Hera for exclusive prop firm discounts. Link in the description. This was Prop Firm Ask, your source for professional trading strategies. Like this video, subscribe for more pro-level insights, and drop a comment with the next strategy you want to master. Trade safe, trade smart, and I'll see you in the next video.